Investment is a conversation. Investment doesn't happen in the first meeting.
Today's guest is a seed stage investor who has spent more than a decade backing founders. His investment philosophy is simple but rare.
Fundraising is a byproduct. It's just in a statistics.
A transaction lawyer by training turned venture capitalist by choice, he brings a structured, thoughtful lens to seed investing.
Being a lawyer gives you that insight to read between the lines, understand what is being hidden, what is not being told.
What are those characteristics that you see in a founder which tells you that he or she is a long-term player and going to be there for at least 10 years?
We don't want to understand every roadmap, every business plan, every expansion plan. You give me the core product. We always listening for one simple thing, that what's the edge? What have you seen or built which others have not done? I love founders who keep on sending us the updates, even though we have not funded. The moment you feel they're at the right place, it becomes easier for the founders as well.
Welcome back to Pitch, Fund and Scale, your startup masterclass in small, practical doses. Today's guest is a seed stage investor who has spent more than a decade backing founders at a very early stage of their journey. He focuses on partnering with early founders building technology led businesses with a clear emphasis on people, conviction, and long term alignment. His investment philosophy is simple but rare. Back founders who are willing to spend the next decade with him. Invested in close to 60 early stage startups and saw multiple exit. A transaction lawyer by training turned venture capitalist by choice, he brings a structured, thoughtful lens to seed investing and is deeply involved in mentoring founders and contributing to the ecosystem. Please welcome Dhiraj Sinha. Welcome, Dhiraj.
Thank you, sir. Thank you for having me.
So, how does your legal and the transactional work that you have done in your early career and that background still influences you in thinking about investing and identifying the right founder, the risk assessment, the structuring for alignment, and long-term thinking? How does that early stage training that you had as a professional lawyer shape your investment philosophy that you have today?
I get these questions, these days, a lot. That how does a transaction lawyer? Because typical VCs are the financial analyst, right, or the guys who are the CFOs and all. But my transaction lawyer experience and the training, influences me a lot. Than what others assume, right? Because even when I was a lawyer, if I can, tell you a little bit about that, I was never a lawyer who was happy with, reviewing the documents or reviewing the contracts or drafting something. I was always, involved into the operations and, with my right mentors, with the right seniors, whom I worked with from, early part of my career. And a lot of credit goes to them. I was always involved into the operations. When I was in real estate, as their legal counsel, I never left that law, behind me, if I can tell you that. And I always carry the framework even today when I invest, when I meet the founders, because being a lawyer gives you that insight to read between the lines, right? You know what and I always assume whether you are sitting in investor meeting or in IC or anywhere else, that you are always working with the incomplete information. Yeah, right. So you have to dig the extra information. You have to read between the lines, understand what is being hidden, what is not being told. Yeah, right. If a business plan is presented, you always tend to understand what are the assumptions. Yeah, right. So those are the training which I got from the from my law background, and it also taught me the discipline. Right. And in investment, you meet successful founder, repeat founders. You got excited. I know you tend to invest. You tend to put larger money in them. Valuation is growing. You put larger money in them, but the discipline, what law taught me that you read between the lines. Sometimes things can be emotional. Sometimes there is a momentum. Sometimes there is urgency. But my training gave me to hit the pause button, saying, okay, let's wait, let's read, let's dig more, let's meet one more time and then decide. So I have kept that framework in my investment thing also.
Very nice. Very nice. So let's talk about the Silver X fund. Why does it exist? How does this idea came, and how it is different from all the funds that are out there in India and having international investor participating in it?
Yeah, so I think I'll answer you first. Why SilverX? Why it happened? Why, because So when I started investing in pre-seed, and I did a lot, I did around 80, 70, 80 investment in early stage pre-seed companies. Right, over a period of time, I realized that in early stages, you are basically believing on the patterns. You are seeing the patterns. You feel excited because you're backing something where idea is still unknown to the market, right? You're investing in something which is not even out in the market. Not many people know about it. Yeah, right. So you back your belief, you back your conviction there. Yeah, right. At the seed stage, so there obviously you spread out, you put in smaller checks, you put in large number of companies. But over a period of time, as I matured as an investor, I realized that you don't build outlier companies, you don't build generational companies in through smaller funds, through 3 to 5 year cycle. You need to be putting a larger check because it will take 7 to 10 years to build that. Yeah, right. And that is how I moved. I stepped. I took one step above on the ladder, saying I will build a seed stage fund which will focus on putting larger capital, putting a large, a part of the fund as a follow-on rounds, invest in fewer companies, but invest, with deeper involvement, right? So you take 15% to 18% equity, you sit with a board seat, you put larger check, you put like the SilverX fund, has a thesis of putting around, 5-6 million dollars per company in average. And some of the good companies, it can also go $10 million, right? So idea is to have fewer companies, and build the ability to stay patient. Because if you have smaller capital, I know you get diluted a lot, and there is no conviction for you to stay longer. But SilverX, and the seed stage where we are operating or we will operate, our focus is that we, back the frontier technology founders. We, sit with them for a longer time, be patient, let it, optimize the value rather than, spreading ourselves thin, and all. And we'll stay patient, we'll work with them, and wait for that optimization of things to happen. Now, the difference between what other players are in the market, I think we are operators. We think like operators. We help the founders, on their entire journey, and we have that experience to bring them the scale, in addition to the money. Right. And we have always been focused in the deep tech. A consumer tech fund, a consumer fund moving into deep tech probably will have that challenge. But for us, we have been always focused for last decade, into the deep tech, and we have built our expertise, we have built our connection. There's a lot of synergy between our existing portfolio companies and the potential portfolio companies, which we feel probably will the differentiator in the market.
Great, great. So $5 to $6 million. So what do you look into a founder at a seed stage? The idea, the market, the founder himself, uh, founder quality as an anchor, ability to learn and adapt, clarity of thinking. Because again, it is a pre-seed seed stage, so it is a very, very fairly young company. So
Correct.
what do you see in the founder before you meet the investment?
So I think I would say founders is the most common part of it. All the three factors, but we always see how the founders react between these two three things, right? The idea and the market, and how he behaves. So for us, I would not like to let's say put a hierarchy or an order, that what we look and what we don't look, and in what order. But we always feel that the founders, how he behaves between the market and the idea, because the market can change. Market changes a lot, in 10 years. The idea changes a lot, the problem statement changes a lot. All right. So at that stage, how the founders behave between these correlations is something what we always we always look at it. I know when we were pre-seed stage, we were always looking at the ambiguity, right? We were The founders were always thinking ambiguity whether it will happen or not happen. But when I come to the seed stage, I am observing that how they're behaving, how they're analyzing the early tractions, how they're going about it, how they're feeling about it. Customers, pilots, is there any, is there some pull happening, with them? So a lot of these, a lot of these founders' reactions, founder behavior becomes important for us at the seed stage, and that is where and that is how we make a call between to invest or not to invest.
Right, right. So, what signals do you see that this founder is a long-term player, and he has a long-term potential in him? Because I've seen that once you reach to Series A, Series B, many a times the new set of investor will tell you that now we need to bring a professional team in place for the next 6 to 7 years of journey. So, you as a seed investor, and with your philosophy that I would like to stick with this company for at least 10 years, what are those characteristics that you see in a founder which tells you that uh, he or she is a long term player and going to be there?
For us, and for me, it's always the founder product fit, right? What he is building, right? Is he doing it from his experience? Has he understand what it takes, or it is just a secondary research what he has done from the market saying, hey, this idea would work, or this idea everybody is doing. So for us, I think what we look at the founder is the founder product fit. That what he is building. Also, as we move, in the journey, we always feel and we always tell the founder that, hey, the center of gravity also has to move. A company, 1.0, 1.0 and company 4.0, same person cannot build, because you need, a larger team, you need more people around it. So we always see, how is he capable of, evolving over a period of time, because market changes, team changes, demand changes. So he should have the curiosity and the ability to reinvent as we move in the journey. For us, that's more important. I think another thing also is that you know does he create that he separate the value and the strategy, right? Because value is one, strategy is different. You can't have the same value you create over a longer period of time, but the strategy should change. So things will evolve, market should evolve, your strategy, your technology, all that will evolve. But the founders has to understand that value should remain same. It should be same under the the different pressure. So those are some thoughts, some ideas we get, and that's why we meet for 4 5 times before we decide, because in one conversation you don't you don't get that feeling. So we meet founders 4 5 times, we talk to the customers, we talk to the team, we visit their offices, we see how the office culture is, and then and then we decide. So once you start meeting up, the patterns starts emerging, and for us that is where we feel that we are confident, and we feel that this founder is something what we are looking to work with. We do that. We have experiences where we see founders doing valuation shopping and all, and we, despite of probably company would have been doing well now, we had said no many times. So some of these things we always see, and then decide.
Yeah, so let us take us through the investment process of SilverX from the first meeting. How they approach you? Do you only meet with the founders who have some connection or coming through a referral, or anybody from anywhere in the world can apply to you? What is that process? And take us through the whole investment process from you getting a pitch deck and how you get a pitch deck, and take us through the complete process of SilverX investments.
So I think, see, the reaching out happens both ways. Now we are at stage sales, so we keep on looking for the exciting founders, exciting technology, what is happening. So with that, that comes from a lot of our networks, our venture partners whom we work with, our investors. whom we work with. We also get the inbound from the founders also. We meet them in various events where they're talking or they are presenting, and we exchange notes and they reach out. We are trying to understand that what they're doing at what stage. So a lot of those outreach happen both ways, and in India being an exciting market, our job is to find the exciting founders. All right, so that reach out happens both ways. But I think in the first meeting, if I can tell you, very clearly, we are not looking at the, we are not focused on the pitch deck for sure. Yeah, right. We always look for clarity in the founders that what they are pitching, yeah, right, rather than the pitch deck itself. Right. If he understands the problem, he understand what has worked with him, what has not worked with them, are they comfortable, in telling about the messy parts, the challenges, right, the struggles, so I think the first meeting, that is how it happens. It doesn't happen. We don't look for the pitch deck at all. Because pitch deck we can always read, and have our analyst make a summary of it. But first meeting always is to just the founders, how how the execution, how his execution skills are. Is he comfortable sharing the bad things also? And then I think next meeting happens. We start talking about the directions, the stages of the company, what what has changed, what has not changed, what are the plans, what are the assumptions. So then deep dive happens, after that, yeah, right, as a process. And then we also, and then obviously there are certain regulatory processes where it goes to the investment committee and all. But before that, we ensure that we meet the founders, two, three times. We will meet the team. Founders also meet each one of us because each one of us has a different skill set, of judging the founder, reading the founders, and reading the business. And then we feel that his idea is yeah, is investable. We take them to the IC and then follow through the regulatory processes. Right, but it's a 4 5 months process since we start meeting for the first time.
Mhm, mhm. Makes sense. So obviously in your previous fund and now in this fund and with 80 plus investment, early stage investment that you have done in the past, you must have seen a lot of pitch deck and met with a lot of founders in your life, Dhiraj. Uh, Tell us some of the common mistakes that the early stage founder or a seed stage founder does when they are pitching to a fund like you. Is it over polished storytelling, avoiding uncomfortable questions? What are those? What are your learnings? I needed to help the founders that hey, if you are in seed stage going to raise funds and reaching out to funds like yours, SilverX and whatnot, don't do these silly mistakes. What are those?
I think, and obviously, founders have matured over a period of time since we started investing, in 2013, 14. Founders have also matured, but a lot of mistakes, founders do, is that they, start explaining a lot of things, in the first meeting itself. Yeah, right. Where, if you are not able to explain to me in half an hour of your pitching that what you are actually building, yeah, right. Everything else, is lost. Yeah, right. So that is the first mistake, what they do, and we call it like confusing details with clarity. Right, so you put a lot of details but the clarity has lost somewhere in between. So that is always my advice to the founders, that please explain it to me in the simple terms when you're meeting an investor for the first time, that we don't want to understand every roadmap, every business plan, every expansion plan. You give me the core product, what is that, and what you're building, what is the problem, yeah, you are trying to solve. So we are always in all the pitching, we always listening for one simple thing, that what's the edge, what is the what have you seen or built which others have not done, right, rather than giving me all the details, over positioning. You do a lot of activities, you show me a lot of your press releases, awards and all, but that is not I'm interested in the first meeting. I'm interested in the clarity. And I also feel that, probably founders also have to understand, that best pitch decks are basically the simpler and simpler ones rather than making it too detailed and all. So when you meet a founder as an investor, you should know, that what they're building, are they the right people, and why it matters what they're building. If you're not able to communicate to to me that in half an hour, and probably there's a lost opportunity. So that's the very common mistake which I feel every founder, many founders do. Though founders have matured a lot and they have a lot of advice available in the market, system has matured, system will be very helpful, but still.
Mhm, mhm. Makes sense. Let's talk about pre-seed versus seed, and you have invested in both those rounds. Um, what is the fundamental changes that you see in these stages as a investor? Is it evidence versus vision, early traction signals, team and execution maturity? What is a pre-seed in today's environment, and what is a seed? How do you differentiate that from SilverX point of view?
So in pre-seed, you are basically looking at the fog, all right? That there will be something when the fog moves, fog goes out, you will see the clarity. So lot of pre-seed investment, when you do, you see that happening because something which is not known to the world. There is an idea, there is a founder, and and founder is probably the right founder to do it, and you go on that conviction where you invest with him, and see with the capital, he will be able to get the product to the market. At the seed stage, we are always looking for some traction, right? The pilots, what you were talking about, has been converted into traction, some revenue. There are some clients, real clients with whom we can talk to, and understand what they have done, right? And then we also see the maturity in the founders. We also see how the founders move from pre-seed to seed. Does he has clarity? Does he has, because see, capital, it's just a, what you call accelerator, right? Capital, when you put the capital in, the money will give you the, acceleration, accelerator to build it. But the clarity has to emerge when you are in pre-seed to seed stage. And that's the difference where we see that when I was investing in pre-seed, casualty rates are higher because a lot of things which you felt was working or would have worked does not do because market shift. In seed stage, you want more maturity, more stability, into the founder behavior also, and in the company traction as well.
Mhm, mhm. Great. Uh, yeah, let's talk about the ecosystem and the mentorship that you do using the TIE platform. You're an active member and a chartered member of TIE Patna. How should an early stage founder actually uses the ecosystem platform effectively? Something like a TIE platform.
Right. I think many founders which I have felt, which I have met, I think they miss that point. They come to TIE, looking for, funding. Whereas what they should be looking at the experience, because that experience is not available outside or available at a cost where it is coming free for you. You're walking into a room where, let's say, people like Anshuman Sinha is sitting. If you talk to him for money, probably he will, take 10 days to, decide. But when you ask him some guidance, some experience, how you have done it, or any senior founder, a businessman, he will have that idea to, he will have that experience, to share with them, which does not cost much. All right. So I think that is where, I have always felt that, all the young guys who walk in into TIE for funding, etc., they start on the wrong foot. They should come meet the people, senior people, experienced people, and and they take that, they access that experience rather than saying I'm coming and I should take funding, and funding should not be your first conversation. Funding is a byproduct. Relationship is the main. If your relationship is built, funding will happen. A lot of other things will also happen. Right.
So, one red flag you spot quickly.
The red flag which I always see, when people lie about the numbers. And I think that's because I came from the transaction background. So I know, I generally, most of the times I'm correct. Which when I notice that, they don't know the numbers. They don't know what is the market. They don't know their basic things, their business plan, are half a trade. They don't need how much they want to raise. So the immediate red flag I notice is that where they don't know the numbers. And some people take very confident guess as well, but when they don't know the numbers, I think that's the red flag I spot very quickly because of my transactional background.
There are one or two traits that all great seed founders shared between themselves.
Uh, I think it's for me, it's ownership. If a founder, is taking responsibility when he goes wrong, don't excuse, don't, point fingers to others, don't make, films excuses. I think that's a main trait for any, good founder who can build, because if you are ready to take ownership, don't take shortcuts. I feel, that this person is, good to, back. I think that's the main trait I see, in any good founder.
Ownership. Know your numbers and ownership.
Yeah.
One myth about seed stage investing.
I'm always a VC, so probably maybe, it's a tricky question for me. But I always, feel that, if a VC says no, it doesn't mean, that you are not fundable, right? Because it's my thesis, it's my stage, it's my, maybe too early for me. Let's say pre-seed company comes to me, I won't fund him, not because, company is bad. So I think the myth is that once the VC says no, it becomes that, hey, company is not fundable. It doesn't work like that. It depends on lot many things. So I think that's the myth which, I want to say.
Great. One mistake first time founders make. Majority of them.
I think most of them are, they get into the peer pressure. And they want VCs on their cap table. I think, in early stage, Dhiraj Sinha as an individual investor can add more value than SilverX fund. Just the naming it, or let's say Anshuman Sinha can add more value as an angel investor with a smaller check than a VC. But what is happening these days, and I have seen this in smaller cities like, Patna, and Indore and Bhubaneswar. Every founder who is, who feels that he is worth something, he wants a VC on the cap table. But VC do not come, at that stage. VC has a lot of criteria. So that is the, I think the very most common mistake, most of the first time founders make, that they want, there are government schemes available, there are angels available, there are customers who might be able to give you some money. So don't go into the VC funding, in the very beginning. That's the most common mistake they do.
Right. One question that the founder should ask the investor.
There should be lot many. I think because and we get a lot of questions from the founders these days, at least the founders who are at a, at a higher stage, at a growing stage. But I think all the founders, should always ask the investors, what is your thesis? How you behave, right? Uh, uh, how good you are with the founders? How do you behave, after the investment, right? That questions I think everybody should ask when, let's say, founder is not performing, yeah, right. Company is not performing. How the investors behave. So that investors behavior pattern also founders should check. And they should be very, very, open about it when they meet the investors. And there are many ways to, know about it. They can always go back to their portfolio companies, talk about in the market, how they behave when the things are not going well. But that every founder should talk, because it's a, 7 to 10 year journey relationship. It's not like it's a lender, relationship where you give me the money, I'll return the money tomorrow with interest. So that founder should ask. We get the most of, many founders ask these questions these days, but still, the percentage is another lower side.
Okay. Okay. So let's talk about a final advice for founders who are raising a seed round right now. If a founder plans to raise the seed capital in the next 4 to 6 months, what should they focus on starting today?
They should focus on building. Yeah, right. See, fundraising is a byproduct. It's just in a statistics. The building is something what you are building, and what you will build over next 6 months is most crucial part. Because they start thinking about fundraising every day. Right. They make a target that today I will have to reach out to 10 investors. I think they put the building on the back burner. So they should continue focusing on building, and don't be in the constant raise mode, because that really put the business in the in the back, on the back burner. They should also build the data points, to show to the investors or to share to the investor. The guys who spoken earlier, who is not part of our cap table today, reach out to them through your smaller numbers, through your through your through your growth, what you have done, right? Build that rhythm. What you have learned, how you have grown, how the team has happened, how the progress has been happening. So those things matter, because the investment is a conversation, and investment doesn't happen in the first meeting. You have to build that conversation with the market. So if you are planning to raise, say 12 months later, next 6 8 months you should continue on the building, the product, and also the conversation, because over 6 months is a long enough, is enough time to change that quality of the conversation which we have been doing. Yeah, right. I love founders who keep on sending us the updates, keep on, sharing the progress, even though we have not funded. They keep sharing. That conversation is built. So the moment you feel they're at the right place, you start that conversation. It becomes easier for the founders as well.